As a real estate investor managing multiple properties, have you ever wondered whether setting up your own property management entity might be the smarter move? You're not alone. Many investors debate between self-managing, hiring out, or creating their own property management company. I'm Jeff Hampton, asset protection attorney and founder of STR Law Guys. In this video, I'll walk you through the implications of using LLCs or corporations for property management and the tax implications from each one. Stay tuned because making the right choice here could dramatically improve your profitability and safeguard your investments. Now, before we dive in, let's set the stage. If you run any type of rental properties, maybe Airbnbs, whether it's short-term rentals, whether it's long-term rentals, you name it, whatever it is, you have to ask the question, do I need a property management entity for my properties? Most savvy investors already use a combination of limited liability companies and land trust to protect their assets. However, the focus often leans heavily on property ownership and asset protection. But I don't want us to overlook the importance of using a property management entity to protect your assets. Why consider a property management entity? Well, number one, you'll simplify your operations. If you own and operate 8 to 10 or 20 different rental properties, the last thing you want to do is be having to make multiple payments from multiple different accounts. If you set up a property management entity, you can actually make sure that you are streamlining all of your payments and collections. Number two, you can enhance your anonymity. By setting up a property management entity, you can keep your ownership discreet and separate from paying tenants. Number three, you can increase your asset protection. Adding a property management entity could add an additional layer of protection, separating you as a shield from those personal assets and your business assets. And then number four, tax advantages. If you select the right entity with the right status, it could benefit you from a tax perspective. So let's look at scenario number one. What if you self-manage your own properties? So if you self-manage your own properties, the first thing you're going to want to do is have each and every one of those properties owned in an LLC. So let's say you've got two properties, LLC number one, LLC number two. You then want to have a parent company or a holding company that then holds those two properties. One here, and then you want a holding company above that literally holds both properties below. By using a holding company for your two state-specific LLCs, you're actually now establishing more privacy and anonymity so that attacking lawyers can't tell that you own these assets or control them. And then number two, you also have what's called charging order protection, which means even if you have property in a poorly protected state like California or New York, using the right type of holding company, like a Wyoming or Delaware LLC, can now allow you that even if you lose the lawsuit and there's a judgment against you, they cannot force you to sell the property. Now, what's the problem here? Why would we even consider a property management company? Well, the issue is the more properties you add underneath. Right now we had 1 and 2. If you add 3, 4, and 5 additional LLCs underneath, now you've got separate bank accounts, separate EIN numbers, separate expenses. Your books can get pretty complicated. The other risk is that if you self-manage your properties, you'll reduce your anonymity if you don't have a property management entity. Think about it. You're now interacting with those tenants on a one-on-one basis, and there's nothing to separate you in a property management role from your ownership role. Number three, it increases your personal liability risk to run self-managing properties without a property management entity. Why? Because you're doing direct interaction and involvement with tenants, thereby increasing the prospect your personal liability may come into play. So what is the solution? We actually want to set up a property management LLC that then manages the other assets. Why do we want to do this? Immediately we increase our operational efficiency. Think about it. This property management LLC over here can now have one single bank account. You can pay all of your expenses. You can collect all of your rents. You can actually have each property below pay its share of expenses to the property management LLC over here. And then it can actually pay all bills and expenses. You can have one common credit card. It simplifies your operations. Number two, it enhances your anonymity. Now all of your tenants are working with a professional management company, and it is done so through a property management LLC. So it's not specific to your personal involvement. It also helps because you can now position yourself as merely an employee of the property management entity. You're only acting as an agent, interacting on behalf of the property management company. Number three, it increases your asset protection to have a property management entity. Think about legal issues that might come up. You could have somebody try to sue you over legal issues or an alleged discrimination. Now they're going to actually have to sue the property management entity, not you personally. So now that we know we have to set up a property management LLC, if you're self-managing, we now have to decide what type of LLC we're setting up. We essentially have three choices. We have a disregarded entity LLC, like a single member LLC. We've got an S corporation that we could set up. In that situation, you'd have to file an 1120S tax return. Or we're talking about a C corporation, which is a separate taxable entity, a separate entity all in itself. And there you would have to file an 1120 tax return. So which should we choose? Let's talk about the disregarded entity first. The disregarded entity option, if you're running a property management LLC, is best for people that have minimal investment properties and minimal income that's derived from those properties. The biggest benefit of using a disregarded entity for your property management LLC is obviously it simplifies your tax returns. You don't have to file a tax return here, and all of your expenses, everything flows directly through to your personal return. What about the C corporation? This option is best for investors seeking tax optimization and they're willing to file a separate tax return. What are some of the advantages here? If you use a C corporation for a property management entity, one of the things you can do is you have the ability to retain earnings at a flat 21% corporate tax rate. You can also offer fringe benefit deductions. However, under this option, the property management LLC both collects rents, it pays expenses, and it retains profits, which are taxed at the corporate level. What about the S corporation here? Just be very careful about this because the big issue is that it is flow through income. So I don't know what, if you've got a really high taxable rate for your tax rate, you have to understand that all profits will pass through to your personal tax return and you could increase your taxable income here. The other problem is S corporations can establish loan complications for you. The main reason is because K1 forms from S corporations can complicate the loan process and approval for your personal loans. The big thing I want you to understand is this. If you know that you're primarily having just maybe 3 or 4 rental properties and you're setting up a property management entity, LLC, the main goal with that property management LLC is that you really don't want to earn any money on it for the most part if you're not, unless you're earning, literally really, really high amounts of income from your properties. You want to make sure and just zero out that property management LLC. Use it primarily to make your expenses easier to pay. Use it primarily to help with your bookkeeping process. But it's not something you have to actually make a lot of income from because you're primarily using it to simplify all of the bookkeeping and make it easier for you to be able to manage your properties. Let's look at situation number 2. What if you don't self-manage your properties, but instead maybe you've got a portfolio of properties out of state and you use professional management companies to actually manage those properties? Do you still need a management LLC for your properties? There are 2 reasons you would still want to establish your own management LLC if you have another property management company managing your properties. Number 1 is you can establish further tax benefits. Number 2, you can streamline your control and oversight over your properties. What do I mean by additional tax benefits? Well, you can technically charge an additional layer of management fees for tax strategy. In other words, even though the property management company already charges you, let's say 10% to manage your properties, you could actually charge now an additional 15% for the money that comes into your property management LLC. You could charge an additional 15% as a management fee to help further reduce your taxable income. You could then retain those earnings in the C corporation if you choose to go that direction. And by doing so, you can lower your taxable rate. And likely, if you're in that 37% tax bracket, you may be able to pay that 21% corporate tax. And under that arrangement, you can then write off all the additional expenses that are available to you under a C corporation. And we covered some of those, but I want to make sure and remind you, some of these fringe benefits, deductible expenses like health insurance, retirement contributions, certain reimbursements, income splitting. You can actually retain income in the corporation at that lower rate, pull out what you want to pull out, and you'll have more flexibility in deducting business expenses in that type of structure. Another reason I like to use property management LLCs is that you can improve your control and oversight. You can do this by formalizing management agreements between your property management LLC and your actual LLCs holding your properties, even if you have another property management company actually managing those properties. So how do we go through this? How do we set up a property management C corporation under the example that we just discussed? Well, let's say number one, if you have an out-of-state property manager collecting those rents, remember you've got another property management company collecting the rents. They collect the rents, they deduct their fee, and then they remit the remainder of that profit that you've received to your management C corp. That's step number one. Step number two is that we then have a fee arrangement where your C corporation, your C corp, charges your property LLCs an additional management fee, further reducing the pass-through income you end up realizing. So let's use this as an example. Let's say we've got rent collected of $3,500 a month. Okay. Then let's say we've got a professional management fee that you're paying to your professional property manager right now of 10%, which would be $350 a month. And then we've got net to your management C corp. What's left over, that's going to be $3,150 per month. And then we take a look at the management fee that you're going to assess on top of this, which is an additional 15%. That's going to come out to $500 per month that is now retained in your C corporation. And then the remaining funds to your holding LLC will be a total of $2,650 a month. By taking this strategy, you have now just reduced your income by diverting some of those resources by your property management fee to be retained in your C corporation. You now lower the taxable income passing through to be realized on your personal tax return. You say, well, what do I do with that $500 in the C corp? Well, you use that to fund all of the wonderful fringe benefits and tax deductions that you can use in that C corporation. Health insurance, all the other things, deductible expenses, maximizing your tax efficiency. You can fully make use of those through that structure. So what's the big takeaway here? If you're self-managing your LLCs, maybe you've got short-term rentals, Airbnbs. If you're self-managing, the main benefits is that if you use a property management entity LLC, you're going to simplify your operations and your banking. You're also going to be able to enhance your anonymity with those assets, and you're going to also further add a layer of asset protection by using a property management LLC. However, if you're self-managing and you find yourself making a large amount of money coming in from your rentals, and you would like to pay less money, less taxes on those rentals, you could consider using the C corporation strategy we just talked about a few moments ago. Retain some of that money to be kept back in the C corporation to be taxed at a lower rate. And guess what? You've got all those fringe benefits and all those deductible expenses that you can use as part of the C corporation. But what if you're an investor with out-of-state properties and you're using a property management company already? Well, remember, there's several benefits we talked about by using this. Number one, you can further reduce the taxable income through additional management fees. It also provides you greater control and oversight in property management activities. And then finally, it enhances your overall business structure for both tax and legal purposes. Understanding whether to establish a property management entity is critical to not only making sure you can maintain your asset protection, but also your tax efficiency. By implementing these strategies, you are going to be able to ensure to improve your after-tax income. You're also going to be able to further protect your assets. And then on top of that, you'll streamline your operations. But what if you have rental properties, but really haven't done much to protect them from greedy lawyers? I want to give you something today. Check down in the description below. I'm going to give you a free resource that will help prepare you a guide for which to know that you can sleep at night knowing that your assets are protected and greedy lawyers can't take them from you. By the way, bad real estate advice can cost you everything. Check out this next video where I break down where investors got bad advice from a DIYer and a bad lawyer, and it ended up costing them everything, and what you can do to protect yourself. See you over there.